Market risk. How do banks have enough capital to cover losses due to external factors, such as market prices, foreign exchange, and commodities? Have you ever not been quite sure about what's going to happen in life, an external factor that might impact you? You could say the election's a brilliant example. In a similar way, banks don't always know what external influences might impact them, such as movements in market prices, including foreign exchange or commodity prices. This is called market risk, and if the impact is adverse, then it means that the bank is at risk of making a loss. So it needs to have a supply of capital to cover any such eventuality. A bit like if you have an external factor that might impact you negatively, then you might have, for example, savings or a sinking fund to cover any loss. The Basel Committee on Banking Supervision stipulates minimum capital requirements for market risk, and there are two ways in which it can be calculated. One is the standardised approach, and that is where you assign risk weight to exposures depending on asset class, and you can determine that typically via an external agency that gives you a rating. The second way is via what's called an internal models based approach, and this can be more complex, and it's based on a VAR or value at risk model. And because it can vary, there's recently been a different approach called the Expected Shortfall approach that can be used sometimes as an alternative. However, like I said, it depends on the bank's supervisory authority approval. Following the banking crisis in 2008, own funds requirements for market risk was put into the Capital Requirements Regulation that you can see here. However, I must add that there's been several revisions since then. That was from 2013, and this is the Capital Requirements Regulation number 2, which is in 2019, and it's enhancing the process. And as you can see, it specifically states here own funds requirements for position risk, foreign exchange risk, and commodity risk. As part of Basel III reforms, the prior Basel II capital requirements for market risk were actually revised and replaced with a minimum capital requirement as of 1st of January 2022, replacing the current minimum capital requirements. Market risk is reported under COREP or common reporting, and there are 8 templates, of which 6 relate to the standardised approach and 1 to the internal models, and the final one being for credit value adjustment risk. So the ones for standardised risk include the position risks for debt and equity, specific risks, and also foreign exchange and commodities risk. This is a standardised approach for position risk in equities, and you can see the long and short positions and your own funds requirements. At the end of last year, December 2023, the Bank of England PRA published PS Policy Statement 1723, and that's included some changes to market risk, as you can see here. Here's the market risk supervisory statement that's near final, and the key changes are there now are 3 approaches that you can use to calculate market risk: the simplified standardised approach, the advanced standardised approach, and the internal model approach. And there are also changes to how to calculate default risk and transitional arrangements for CVA. However, these are near final, so there might be some more changes to come.